morning, everyone. This is Mortgage Pros 411. I'm Audrey Boyce-Snow with Kevin Casey, and today we are joined by smiley face Rob Chrisman. How are you today, Rob?
I'm good. I'm good.
Good,
Can't you
I'm
tell by
cold,
a
but I'm
smile?
good.
good. Are you guys noticing the 10-year T-bill this morning fluctuating between 4% and 3.99?
Can I correct
Uh,
you? Can I correct you right off the get-go?
Well, I don't know. Since I've been watching it all morning, I'm curious to see where this is going.
So the government issues bills, notes, and bonds. Bills are typically a year or shorter maturity.
Oh, shit, you're right. Treasury, not a T-bill.
Notes,
Yeah,
yeah.
Treasury. Okay, you're right. I stand corrected. Thank you, Rob.
But then bonds are typically, 20 or 30 years out. So,
Yes. Well, this is Rob Chrisman, who is the keeper of many facts and little gems like this. Ready?
so where's the yield now? Start over on the 10-year T
Uh,
note.
Somewhere between 4 and 3.99 is where it's been flashing this morning.
Uh,
Okay, so these are little gems you can expect to read in the Chrisman commentary. Remember to bring up politics at Thanksgiving to save money on Christmas gifts. Yeah, there's some good advice for you. Or how about this? What do tornadoes and Tennessee divorces have in common?
Wait,
Someone's
wait,
gonna
wait. Repeat
lose
that
a
again. I was
mo
sorry. I was laughing over
Kevin,
the last one. You have to start again.
what?
I was still laughing from the first one. You have to start all over again. Sorry.
What do tornadoes and Tennessee divorces have in common? Someone's gonna lose a mobile home. Oh God. Anyway, so for gems like that, sign up for his Christmas commentary that you can receive every day in your inbox, sent out at the crack of dawn. So, here's a question. Do I need to keep reminding everyone to renew their NMLS?
Oh
Or
my
does
God.
everyone know that by now? Kevin,
No,
I told people over and over again to go to NMLS, check to see if they needed background check,
I did
fingerprint,
all that,
and you
Audrey. And
did.
guess what?
What happened?
I need a background check. You know
Yep.
why? Because I went in on like beginning of October and I looked, there was nothing needed, nothing. I even called. I said, NMLS, do I need to do anything else other than pay for my licenses? They said, no, you just have to pay, you're good. So this week I went to renew my licenses, I paid them all, and guess what I had to do? A background check. You know why? Because my
Because they
previous
figured out who you
background
are.
check expires on October 27th, 2026. So it's not good enough for the whole year. So now I have to go out and get another set of fingerprints.
And you have to wait for them to process your background check. So that'll be
Oh.
interesting. Okay, so this is for my processor, Alex, who last week was waxing poetic and asked if we were going to do a eulogy for the penny. And he had a couple of ideas. Like in the future, do we now say a nickel for your thoughts instead of a penny for your thoughts? So I thought that was kind of funny. But also interesting to note, they're not taking pennies out of circulation. They're just not making anymore. And apparently there are billions and billions of them in circulation. So don't fret. You'll still be able to use pennies. Uh,
What about all those copper pennies I have stored up from before in the 70s when they made them purely out of copper that are now worth $4 a piece?
okay. Well, you should cash those in and, buy a latte.
Along with my silver quarters, half dollars.
How many do you have?
Those are worth, I want to say, like 850 bucks a piece.
Okay. How many do you have and where are they stored?
I ain't saying.
All right. In other news, if you are a slacker, and I really mean a slacker, Mortgage Education Institute is putting on an NMLS class on December 4th. If you sign up on their website, Mortgage Education, geez Louise,
What
www.
mortgage
Mortgage,
education?
it's not helping if you're mortgageeducationinstitute.com and use the promo code 411 save 10. That'd be $10, just to be clear. Uh, then you can knock that out. So don't wait.
Wait, what is that mortgage code again? 411.
411 save 10.
Okay, is that
all small
lowercase?
letters.
All small letters on that save? Yes, it
Don't
is.
know.
all small letters.
Whatever.
If you put large letters, you don't save 20.
Well, I would think the average LO would figure out if it didn't work with a capital S, they would use a small s. Okay, moving right along. According to Treasury Secretary Scott Bessent, Santa is bringing us a new Fed chair for Christmas. Although it's interesting to note that Uncle Jerome's term as chair doesn't end until May 2026, and his term as a member of the Board of Governors doesn't expire until January 31st, 2028. So it'll be very interesting to see what he decides to do in May of 2026. Stay on, get a job.
What happened to our last Fed chair?
Pardon me?
Our last Fed chair, the previous one before Uncle Jerome. Do you remember who that was?
What does that have to do with anything?
Well, I'm just, because she stayed on for a little bit after until she became Secretary.
Yeah, Janet Yellen, before that, Ben Bernanke.
Yeah.
I don't think I don't think that Uncle Jerome is getting a government job anytime soon. He would go into the private sector, I would imagine, and make real money. Okay, so just in case monthly isn't enough for you, ADP now has a weekly employment data report. So this last week, on average, 13,500 jobs were lost. I thought that was interesting because remember, Kevin, we were talking about this last week, I think, and that report showed 11,500, but the initial report was 2,500 job losses. They've now revised that report to 7,500 job losses. So at this point, my head is spinning with ADP weekly employment numbers, and I'm not entirely sure what it all means or how it's all going to, whether this weekly update is going to help us. But with that, the odds of a rate cut have jumped to 85%. So here's the question, Rob Chrisman. Does that matter to mortgage rates, whether the Fed decreases or pauses interest rates on December 10th?
It doesn't directly impact mortgage rates, but what's that?
I said, we know that, but do you think it's going to change the trajectory of mortgage rates?
So, as I was going to say, it doesn't directly impact mortgage rates, but what it does do is impact the psychology of the market, psychology of investors. And I think that overall, right now, given the lack of news, we do tend to trade. Investors do tend to look at non-government information like this ADP number, but it's also important to keep this data in context because there's 50 states, and if every state laid off 10 people, that's 500 people. If every state laid off 20 people, that's 1,000 people. And if you look at the overall labor pool, how many people there are in California, for example, or Missouri or New York, the numbers are pretty small. So when you get into 1,200 of this or 1,400 of that, it's like really when you divide that by 50 states, it's really not much going on. But when you combine that information with other information that from other sources, and we are starting to get federal data now, it points to a job market that isn't great. There's been some big headline announcements by large companies of cutbacks. A portion of that is due to the economy slowing down. A portion of it's due to offshoring. A part of it is due to AI, and so the trend isn't great in terms of employment. But you also look at the people in their 60s or 70s. There's a fair amount of retirement going on. So if somebody leaves a job and they don't replace that person, do you happen to know how that number is counted in the registers?
I do not.
I
But it
think
does show up in the jobless rate because in theory, that if one person retires and someone else replaces them, then that would affect the overall jobless rate because that person now would be working.
yeah.
So
But
if they don't replace that person, which would be unusual because a lot of times, one person leaves, but it creates many more jobs because, one person moves up, another person moves up, another person moves up. And like there's a whole chain of when the top person leaves, people move
Right.
up. Just like I recently had it where, so I have a charity that we run, and the city came out to us, San Francisco, and said, you have to have a minimum wage of $23 an hour. And we're like, well, that's a challenge because while we were paying our person that washes the dishes, $21 an hour, okay, now we have to pay her $23 an hour. But the other problem was, but the sous chefs were making 23 before, and now they're like, well, what is the dishwasher's making the same amount of money as I'm making? I need a raise also. And so it just goes through the whole system. So, just like when someone retires, it goes through the whole system. When a pay increase goes, minimum wage increase goes in, everyone else gets a pay raise also. Of course, then the executive director wants a pay raise too. It's like, hey, I'm giving pay raises to all my staff. How come I don't get a pay raise? And so, yeah, it's a little challenge in the thing. And that's a chunk of a challenge. That's almost a 10% increase in payroll when we only had a 1% increase in our budget. So we don't know
Right.
how we're going to make that one work.
Yeah. So getting back to your question, Audrey, the news may not move the markets per se. The Fed, there's a lot of chatter in the financial news about, oh, December 10th. It seems like they have nothing else to talk about other than the next Fed meeting and the next Fed meeting and the next Fed meeting and what the Fed presidents are out saying, and they're all telegraphing their moves. And so December 10th is the next big, the next Fed meeting. And so are they going to go a quarter or zero? And, it fluctuates based on, you know, Williams saying something or some other Fed governor saying something. And really, if you look at mortgage rates, what they've done over the last couple Fed cuts, I think they've crept a little bit higher. And
Hmm.
so, but at some point, the those investors will say, "Wow, the Fed's cutting for reasons, and those reasons will impact the economy. The economy is slowing, and so that will bring the longer end, as they say, of the curve down, be 15-year or 30-year mortgages at some point. At some point, but there's a lot of noise between now and whenever, and there's never every once in a while somebody will say, oh, blah blah blah, soft landing. Well, our airplane of an economy never stops. It's always flying. It's always going somewhere. There's no landing. There's no stopping of this economy. So as we cruise along, yeah, I would think that the inclination is for mortgage rates to come down some, but not by a huge amount. And when you talk to old timers, they'll say, "Well, I got in the business when rates were 18% or whatever they were," and that's all well and good. If you look at the historic norm of where 30-year mortgage rates are, for example, where they've been, they aren't that far from, I don't know the exact number, but they're not that far from where we are now. So rates really aren't as big a deal as you might think, given what the press says. As you two and I have talked about on the show and in person, and your guests have talked about, you talk about affordability. You can't ignore insurance. You can't ignore the new, assessment from your condo association. You can't ignore property taxes. You can't ignore all these other things that go into the monthly bill of the average homeowner. And that's, I view, as more of a problem than interest rates. But not much we can do about the cost of insurance or some, State Farm yanking writing policies in places like California.
Right.
Heard a couple of insurance people recently say that they think things are starting to level out. Even a State Farm guy was talking about that, and they haven't been able to write homeowners in a long time in California. Back to the unemployment reports, it is interesting. BLS did finally come out for September, It showed 119,000 job gains versus a 50,000 estimate, but as we know, it is very likely and probably going to happen that we'll have revisions. Which way they go will be interesting. With August, they were revised down. So we went from a positive job growth of 22,000 to a negative of 4,000. July was revised down, but only by 1,000. So from 73,000 to 72,000. So a lot of weakness in the jobs market. And we all know that once you lose your job, it's harder to find a job, and the unemployment rate crept up to 4.4%, but actually 4.44%, which is, it would have been rounded up to 5. Also interesting to note that we had about 200,000 government employees who were being paid up through September. So it'll be interesting to see how those numbers impact or not the
Yeah, I don't know if the government workers per se not working is going to cause a thing, but I would say that the government shutdown had a ripple effect where other industries were shut down. So like all the cafeteria workers and all the government offices, they're not government workers, they're all independent contractors. They lost their paycheck.
Yeah.
Um,
People who dressed up like bears at Yellowstone when they start closing national parks.
yeah,
Those Yogi Bear imitators also, they're not going out and buying houses. Audrey's unamused by this conversation.
I don't know what to say about Yogi Bear. I have not been to Yellowstone and have not seen them, so I wasn't sure whether that was real. You made it up. It was some anecdote that you picked up.
but who's stealing the picnic baskets then?
I don't think they have bear imitators. Yeah, Jellystone.
Okay.
Tony.
You never know. I mean, you're the guy who talks about, bringing up politics, so you don't have to buy Christmas present. So, they keep revising the list of economic releases that are coming from the government. So, just things to keep in mind as we go forward, because this has changed a little bit even since yesterday. Economic data releases as of today. BLS for October, we should get it December 16th, but we are going to have a business survey, no household survey or unemployment rate. November, we'll have a full report also on December 16th. Note that that is after the Fed meeting, so that's interesting. For CPI, October is canceled. Just cancel it. Don't worry about it. Not a big deal. November.
But there was no numbers, that's why.
Right.
So why?
We had no consumer price index in October. November, it'll be released December 18th. QCEW Q2 2025, December 19th. PCE will be released December 5th for September. October and November, we don't know. So, it's kind of a moving target. We'll see where we end up at this point. The Fed speak seems to be shifting day by day. And there was a list published of people who were in favor of a Fed cut, those who were against, and those who were undecided. And I took a picture of it to see kind of where we end up on December 15th, 10th, and to see if it ends up being right on or not. Retail sales were up slightly month over month, 0.2. But it was half of what they expected.
Actually, I heard a really interesting on retail sales is they are projecting Christmas sales or holiday sales this year to exceed $1 trillion for the first time ever. And yet, 62% of the people surveyed say that they're cutting back. And yet, somehow we're going to break all-time records in the number of sales. Now, it's interesting. It's how do they know what people are going to buy at Christmas? Because, Audrey, do you know what you're buying for Christmas this year? Have you put together your list yet? Have you set your budget? You
Yes.
have. Okay, I haven't. I always do this, December
What a
24th,
stalker.
right?
Yeah.
And I'm always thinking it's like, the retailers always do these projections, but honestly, where the numbers are coming from is the retailers go out and buy all these goods for Christmas to sell at Christmas, and they are doing this by projecting what they think the market's going to do. And then they always do the same thing with okay, Thanksgiving sales are going to be this price. They don't know, they're just guessing. And I'd always be curious of how close they came to the guess. Like this year, I noticed that Home Depot sold out of all Halloween stuff about a week before Halloween. Like a month before, you could buy all these huge skeletons to put in your front room or your front yard. Audrey, you picked up the horse and the huge skeleton, I believe, right? And the dog.
Maybe never, but yes, keep going.
Yes. Okay. I don't know where you store them, but I think that there is a big business now in storage space because people need to have someplace to put all this Halloween stuff because you got to take it down now to put up your Christmas stuff. Am I correct?
Well, correct on what part of that tirade.
I,
So
I lost track of halfway through.
I don't know. I was stuck on the dog skeletons. That's always a horrifying thing for little kids to see. Like, oh, there's Sparky's skeleton, huh? Um,
My
no,
brother
that's why.
my brother does this huge haunted trail every year on his quite large property, and he was lamenting the fact that he didn't pick up the Bumble. There was a huge Bumble, I guess, on sale at either Lowe's or Home Depot, who knows.
Wait, what's a bumble?
Bumble's from Rudolph the Red-Nosed Reindeer. Remember the monster? The monster.
I
So
kind of
think
remember
back
him.
50
It's
years,
like
and
the
there you
abominable
are.
snowman.
Yeah. And so anyway, and he was really cute. He showed me a picture of him, but he was very sad because they were sold out already. He should have bought it when he saw it. But again, I agree that it's hard to imagine that retail sales are going to be incredible, and also interesting and important to note that the high-end luxury market is kind of propping up retail sales, or has in recent months. So it's not like the average consumer has a lot of disposable income and is able to go out there and have a fancy Christmas. It's a certain segment of the population that's doing that, not everyone. All right, so let's talk about Kevin's favorite topic, conforming loan limits, which came in today. So, Kevin, take it away. What happened?
Well, we already talked about that part. It's hit 832,750, a little bit higher than I was anticipating. Um, yeah, I was thinking it was going to come in around 825-ish ballpark, based on the previous months of increases. But I don't know if we're going to see much of an increase next year. That's the big question mark. Will it remain the same? Because
Kevin, if you
remember,
go, we're going to talk about NAR forecast for next year, but if you take Dr. Yoon's projections, we're going to be just fine. And again, I keep going back to, does it matter very much anymore whether we're at 806 or 832? How much is that impacting people? I'm curious to hear from our
well,
listeners.
that's from your market in Walnut Creek, Audrey, that it doesn't affect you at all because your average sales price is now what, $1.8 million or
Yes,
so?
come
Yeah,
on.
something in
Come
that
on.
ilk, maybe as low as 1.4. But if you're at 1.2 or lower, you could do a 20% down conforming loan.
All right. Yeah.
So, it's actually you can go 1.2, $440,000 and still do a conforming loan with 20% down. So, it affects most of the country pretty well. Unfortunately, in our market, the jumbo market kind of hits us, and it's a different market together. So.
Okay. You're always talking about the fact that your market is San Francisco and you only do jumbo loans, blah, blah, blah. So
Well,
I don't
actually,
know why
San
you're even worried
Francisco's
about this.
Yeah, San Francisco market level's been off for a while.
Mhm.
During COVID, it took a nice little hit right after COVID. Um, but what we're seeing is in Silicon Valley, there's a great article in Scotsman Guide how San Jose, which I always wondered why San Jose is not the San Francisco Bay Area territory, but that's only 45 minutes down away from here. But they jumped. They're the largest growing market in California, in the United States. They went up by like 1 point. I saw the numbers.
Yeah,
I think they're
they're
one
increasing. That's true.
$1.8 million the average purchase price in San Jose, something ridiculous like that. And it's a huge rise. I think they had the largest increase in the country. And where a lot of that is coming from is the back to work orders. So I was talking to someone the other day about how they fly back and forth between Portland, Oregon all the time, and they're saying how tickets have just jumped up, skyrocket. It's really hard, number one, to get a ticket. Number two, when you get it, it's much more expensive than it was just a year ago. And he was talking to this person next to him, and he goes, "Yeah, we all have our back to order work orders, so we have to go to fly back down from Portland, Oregon, because we have the nice cheap house up there with a nice living, and we have to go back to the Bay Area and work for a week or so at least once a month. And so that is driving home prices up and airfares up. So
I bet you there's a video somewhere of me cautioning people when everyone decided that work from home was going to last forever and change everything forever, which it has impacted it. But I kept saying,
Mhm.
be careful before you sell everything and move away if you want to keep your job. It may not be there when you are told you have to come back to work if you want to keep that job and that salary. Rob, thoughts? Okay,
Nothing.
moving right along. PPI for September came in up 3/10 month over month. Core was up a tenth, which was half of what they expected. So, you know, again, we'll see what happens. September was a long time ago, wasn't it?
It was years ago. Um, no, nothing wrong.
Yeah. No, you're exactly right. It's two months ago. It's nice to see the data, but if I'm a fixed income investor, am I going to base, millions or billions of dollars of capital based on numbers from 2 months ago? Probably not. Um, I'll just stay the course. And rates have been, yeah, the 10 years down near 4%, great. Whether it's 4% or 4.05 or 4.10, it's come down a little bit, but
Mhm.
rates have been pretty stable throughout the whole government shutdown and after the government shutdown, because I think that when you don't know what's going on exactly, you just tend to stay the course and you don't know any better. I mean, and you've got to put money to work, and the U.S. Treasury market's as good as any place, as are mortgage-backed securities, as are municipal bonds, and so forth. So, I think it's been kind of an environment where uh, people are, or I should say, investors and money managers, they're kind of content where rates are, and so it's not like I said earlier, it's not such a bad mortgage rate. It's kind of near probably the long-term average. And here we are. And when you watch the financial press or financial news or listen to it like I do, Bloomberg Radio, there's a lot of intraday, there's a lot of drama about these little events and little news bites. But I think that maybe I like to think that if somebody was handling my money, they would have more of a Warren Buffett long-term, non-trader kind of mentality in handling it, because you don't want to run up transaction fees and you don't want to do knee-jerk reactions to something every day or every other day. I just as soon say, you know what? Exxon, good company. It's going to be around. I think I'll buy that. That kind of thing. That kind of mentality.
Caterpillar,
What's that?
Caterpillar, long hold,
Yeah.
keep it forever.
Caterpillar, whatever it might
Coca-Cola.
be. And yeah, there's going to be ups and downs, but with fixed income investors, the money keeps going into the market, but there's also a certain amount of money that's going into the private equity market. And
Hmm.
when you talk to originators like you two, especially Audrey, and you say, where's your, where are you lending? What's going on out there? A lot of them will say, oh, I've really ramped up my non-agency, or I've really ramped up my private money lending. And
Yeah.
I've got a couple sources of capital. And
Yep.
so those loans are easy, and 10% at 2 points up front, or whatever the interest rate is. Well, private equity firms are doing things like buying up veterinary groups
Yeah.
Yep.
or salons or all kinds of things. And that's like this undercurrent economy that I'm not sure how it's measured, but
We
it's certainly
talked.
not,
Yeah.
there's certainly a lot going on there. And I think that's interesting to me. Like their money will always, it's like money will always find a way to do something. And in this case, right now, we're seeing a lot of money flow out of the standard, staid, reputable instruments and into, say, lending private money or buying veterinary, institutions or whatever it might be. That's actually it's interesting and it's also somewhat scary.
It's
Yeah.
really scary. We were talking about this ourselves between two of us because I introduced a client to a private entity that's buying out her business, and they're buying it for millions of dollars. And she's super ecstatic. She loves me to death just because I made the introduction. But we're like, I was talking to my eye doctor, and she did the same thing. She just sold her practice for, millions of dollars, and she's like super happy. But it's like, well, how, and why would they buy a practice for millions of dollars? It's because they know how they can charge the clients much more money than the previous person was doing it. Because the previous person kind of had a loyalty to their clients, and they knew that, okay, wait, Kevin's coming in. He's not going to want to, I don't want to charge him because, like, happens to be my eye doctor's also my neighbor. So we see each other. She's, she always takes care of me. I've been with her since she literally got into practice. Um, and so it's just, one of those things versus a business entity that buys these places. They don't care. They just know, hey, here's a trick how you can get more money from every customer when they get their glasses. You overcharge them for this and you charge them for that, and you offer this and you sell up and you do all this other stuff. And the employees of the place, they either do it or they get fired because it's not, Dr. So and so doing it anymore, or have a relationship with her anymore. It's the company is making that decision. So I don't know how that's going to go. And you're right, like veterinary services are getting really expensive. Eye doctors are getting much more expensive. You're all those services, dentists, they're all being bought up right now. Um,
It is definitely a problem. I listened to a really interesting Freakonomics episode about venture capital and how they operate and what their model is and how they go in, they buy these business, and basically it's not about keeping it going at for any
mm-mm.
length of time. It's about consolidating industry, driving up prices, and it absolutely wipes out small businesses and small business owners, and it's terrible overall, in my opinion, based on what I know, which is not a whole lot to be honest, but
Well,
Right.
actually, I have a similar note on the same thing is, so I've always gone to the same Christmas tree lot to buy my Christmas tree. It's just around the corner. Prices are reasonable. I buy a, well, I happened to run into Home Depot the other day and I was like, holy moly, they got really nice trees at Home Depot now. They don't have those crappy little ones they used to always have. Like they have some really nice selection of trees, and they're like half the price of what my Christmas tree lot charges. And I'm like, do I buy it from the big guy or
Hang tough, Kevin. Hang tough. Hang
big
in
guy?
there.
Yeah. Go back to your Christmas tree guy. And by the way, at the Home Depot in San Ramon, they've had very nice, very well priced Christmas trees for years. Yet I just go back to the little lots. I just want to take a moment because last week I sort of bumbled through a report from Catality about mortgage fraud, and I wanted to explain why I went through a few of the things that they had talked about. So they were talking about mortgage fraud in specific and how volumes, mortgage fraud had fallen 2.7% in the second quarter, but was still up 8.2% in year over year. So they had said that they estimated that 1 in 118 mortgage applications had indications of fraud, which that's a big problem, and we know that. But then there was a comment or a number of comments by someone who was talking about how they thought that DSCR loans were the issue. And I didn't talk about it because he said their theory, which is not a fact, and I think, which is also not a fact, it's the rise of the DSCR loan. But he was talking about income, and we don't state income on DSCR loans. So there can't be income fraud on a DSCR loan. You're using rents and market rents to justify your qualification. So that's where I was like, okay, got off the rails a little bit for me. Um, what they were talking about, which we have talked about ad nauseum in our NMLS classes over the last few years, is that income and occupancy are huge, huge issues. We know that. So income on a regular loan, yes, those things are an issue. But there was also a note in here that was interesting about identity fraud growing. Kevin, why don't you quickly walk them through how people are doing identity fraud and making new
You mean
identity
with credit?
quickly?
So
Yes.
Yeah, so what's happening now, and we just learned about this when we were doing our classes this year. So there's a identity fraud, and the fact that I think they call it credit fraud actually. So these groups or gangs, they are finding a social security number that's not being used by anybody. It's not assigned to anybody. And if you've ever run a credit report, I know Rob, you don't pull credit, but any loan officer here, we've all pulled a credit report where someone, not saying it was me or Audrey did it, but someone along the system input the wrong social security number in the application before they pulled credit. And yet, when they pull the credit, it comes up with the correct credit report, despite the number being incorrect. And that's because the social security number is not the key piece of information on a credit report, despite what everyone else seems to think. It's the name, it's the address, it's a lot of other data in there. And so what these bad guys are doing is they are getting a social security they find is not assigned to anybody, and then they are creating an entity, a person. So let's just say they call it John Chrisman, and they assign Social Security 555555555, and they first thing they do is they go and apply for a credit card at, let's say, Wells Fargo. And of course, Wells Fargo will come back and say, well, there's no Johnny Chrisman assigned to this Social Security number, credit denied. But then that doesn't stop them. Then they go to Citibank and they do the same thing. They apply for a credit card, 555, Johnny Chrisman, and same thing. They get a bad mark. There's no credit. You can't have credit. But they keep doing it. And what they're doing by keep doing it is they're establishing now the records are starting to show, well, wait a minute, this Johnny Chrisman, he's applied for several things, and lo and behold, they've got a history. Now what they do is they go to a company like Capital One that's much more lenient on offering people their very first credit card. And if they put $500 into a bank account with Social Security 5555555 and Johnny Chrisman, and they'll do a secure credit card account. So they put $5,000 in, they get a $500 line of credit. Oh, now they've established credit with the fake social security number, the fake name, the fake address, and they build this over time, and now they can eventually use this to get a mortgage or whatever else because they've created all this fake data over time. Now, I don't know how they get away with it all the way because there's got to be some bells and whistles that are going off that hey, this fake ID is starting to appear, but apparently it is one of the largest growing types of fraud in the mortgage world.
It is. And again, what we're hearing, as we have heard multiple times from the FBI, et cetera, is they're playing the long game. It's all about, it takes time and they're willing to take the time. So September home price appreciation came in, Case-Shiller and FHFA. On Case-Shiller, they were up 1.3% year over year, and FHFA, which does not include cash or jumbos, up 1.7% year over year. So I thought that we could take a moment and talk about NAR's forecast for next year, which is very optimistic and hopeful. Kevin, did you have a chance to go back and check how right on the money or not they were last projection?
I did that, yes, last week. In fact, I have the data.
Great. So
Yes, I do have it. Look
great.
at that.
Okay, NAR is projecting existing home sales to rise 14% or so in 2026. That means the number of transactions. That would be great. Home price growth is projected to increase 4% in 2026. Mortgage rates are expected to decline modestly. This is the messaging we're hearing from most everyone. It's around 6% right now. Don't expect it to go nuts and go much lower than that. So, Kevin, how did they line up against those numbers last year? I mean, were they were they right or wrong last year? That's what I want to know.
Yeah, so let's go for 2024. They had projected 3.8 and it actually went up by 4.0. So they were really close, but they undercut it. In 2023, they were so far off they only projected a 0.1 increase, and it's actually 6.6 increase. So
Okay.
they tend to be wrong, but on the right side of the, if you're going to
Wow.
miss it by that much. Um,
Same.
yeah, so yeah, they projected 2025 to be 2%. And I
Oh,
think we're at 4% for this year so far.
no, 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 not four, but we're gonna end up, I bet you we'll end up right. I mean, if we're looking at, well, this is again September, which was 12 years ago, right?
Mm-hmm.
But if we're at 1.3 and 1.7%, and things have gotten maybe a little better as rates have edged down. So we'll see. Again, we're missing a lot of data already, still, but
Well, if you go off FHFA's numbers, we're up 2.2, but that's not year to date. That's September to September. So
well,
pretty close.
1.7 according
Yeah.
to numbers released today from FHFA.
Yeah.
So,
Although there is a downward decline in the appreciation numbers.
well, yeah, 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 yeah. I mean, it's moderated for sure, but it's still positive overall. Although we noted last week, I think that condos were down in 95% of the markets, which is not surprising, but not great for people who have bought condos.
Actually, now you say that, I'm wondering how many condos are getting their stuff together. I was going to say another S word. Because like I had one this week where the condo didn't have any reserves. And so it bumped out of getting an FHA loan because of that. But that's an easy fix. Do a special assessment, build up your
Easy,
reserves over 2 or 3
easy,
years. Like
easy.
it's not an impossible fix. It's not like the building's falling down and it's going to cost $1 billion to fix it. It's okay, we need 10% reserves. You
My client
increase.
who bought his condo 3 years ago and then found out that his homeowner's cert was complete bupkis. His HOA fees, as they got their reserves together and did the repairs, have gone from $400 a month to $1,400 a month. And there was a $110,000 adjustment. So, yeah, Kevin, just not a big
It's
deal.
in Northern California. They can afford it. They all
Oh
make
my
millions of
God, don't
dollars,
start.
Audrey.
Don't start. Okay, Rob, let's talk about Director Pulte of the FHFA. How's it going for him?
Well, first of all, Audrey, I think you should look at Tony Russo's note. Here, Tony was trying to make you chuckle. So he notes in the chat. He has one for you.
Oh, jeez.
Uh, Director Pulte, where do you start?
Yeah, where do you?
So, not that I'm trying to age discriminate here, but he's 37, which I think is a little young to basically be in charge of a multi-trillion dollar part of our economy. Uh, he has a nice pedigree. His grandfather created a nice company. Uh, I think that he has been trying to make a flash, be memorable, throw things out there, to be charitable to Bill. He does start conversations. Oh, wow, 50-year mortgage? Let's talk about that. Unfortunately for Bill, the industry and even Donald Trump hasn't been wild about 50-year mortgages or portable mortgages or assumable mortgages. And that's in his day-to-day job. There's this whole other side of Director Pulte, which he has, in effect, gone after people who President Trump might want gone after, and has apparently done some things that now cause him to be subject to a grand jury investigation, FBI, Department of Justice. Others are looking at his methods. And so I think that where some people will say, well, where there's smoke, there's fire. Others will say, well, he's not doing anything that anybody else doesn't do. Um, but I think that we as an industry, many people in our industry still are smarting from in 2008, people telling us that we're to blame for what happened to the financial system, and we are to some extent. but we don't like good, news like this does not help our industry. It doesn't help our borrowers to have
Mhm.
Bill Pulte's name in the headlines and being part of a grand jury investigation. It doesn't help. And I think there's enough other issues that he can focus on as director, concrete issues, rather than what he has done. And I would tell him this if he were sitting here in this room. I would tell him that. There's other things we can do to help borrowers versus going after Letitia James or others who, Lisa Cook, who, whatever. I mean, they may be guilty. If they're guilty, fine.
Mhm.
I want to make sure that whatever investigation was carried out on them was done legally. And I get a certain amount of emails from people saying, well, as director of Fannie Mae and Freddie Mac, he can do anything that he wants by using Fannie Mae or Freddie Mac's database. Okay, I guess. I don't know. I assume so, but
I would
nonetheless,
disagree. Like I'm president of an organization and we have all these, confidential information about all our clients. I don't go in and access it and find out what's Jenny Johnson, making or what illnesses does she have. It's like I'm not entitled to that information. I shouldn't be.
yeah, I tend to agree with you, but I've never looked at the legalese. But yeah, I would agree with you. It's not like anybody who works for Fannie Mae or Freddie Mac or anybody who holds a management position in a government agency can look at private citizens' information.
Right. Now,
So
if he did a report and he came out and it was equally based and said every employee is federal government congressperson, and he reported on Democrats and Republicans that had done uh, suspicious activities as far as buying a house that's owner occupied, it wasn't supposed to be owner occupied, vice versa. And he came out of it, had someone do the investigation and they came out unbiased in the reporting, then I don't see a problem with that. But for him to,
Well, I think, okay, the problem is you run a report and you issue a list without an investigation into what really happened.
yeah,
And our conversation with Bob Simpson has made it extremely clear that to prove fraud and occupancy
mm-hmm,
fraud in particular is not easy. And that
mm-mm,
you definitely need to go down the entire chain of events to see whether or not when the deed of trust was executed and said borrower agreed that they were going to say own or occupy a property for the next 12 months. Is that what in fact happened? And then they moved out of it in month 13 and they did not commit fraud. So it is a slippery slope. And I believe I saw something that said Leticia James, the charges against her were dismissed. So it'll be interesting to see what happens. But
I didn't see that report.
yeah,
Somehow they didn't hit the headlines.
And James Comey as well. So I think
that, yeah, I think the prosecutor or the attorney prosecuting the case was there are problem. It's a technicality, and the Department of Justice says, okay, we're gonna start this back up again with a different lawyer, however that works. But I think that when getting back to Pulte and what's going on there, as I understand it, and I have it on good authority, that until he directly hurts the president and is truly viewed as a liability, he will keep his job. It may be suggested to him that he do something else, that he resign, but the odds of that happening are small. And until President Trump is negatively, materially impacted by something that Bill Pulte does or says, it'll be same old, same old.
okay, so a couple quick things. Cotality single family rent index for September showed that rents were down 1.3% month over month, 1% year over year. So that is a trend we have been seeing. Existing home sales for October, that's a little more recent, up 1.2 month over month and
Wait, wait. So
4.1 million units annualized and up 1.7% year over year.
So wait, can you go back on your numbers there? So you're saying rents are down. Is that just this month or
September.
September?
Down 1.3% month over month in September, down 1% year over year as of September. So inventory normal this time of year to see what we're seeing, which is 1.52 million units. It was down 7/10 month over month, but it's up 11% year over year. Important to remember, it's still below pre-pandemic levels. We have a 4.4 month supply, and 4.6 months is normal, with an average of 34 days on the market. Cash buyers, 29% of the market was 27%. Sold above list, we're at 19%. That's no change. Investors, 16%. First-time home buyers, 32%, which is up from 27%, which is better. So all good things, yeah?
Yeah, I don't think that things are we we don't want the days of 2020, 2021. We don't need 20% a year appreciation.
No.
It blows the first time home buyer out of the market. We don't want devastating economic news because yeah, rates will go down, but it's devastating economic news. The economy is not on fire, which would raise rates. It seems like the economy overall is kind of muddling along, and massage the data to death. You can find things in all these in this data that points to this and points to that. I think that the overall the things aren't so bad. And so here we are. So in my travels, it seems like the originators who are continuing on with their job, they view it as a career. It's not some, flash in the pan kind of thing. They're doing the same thing day in and day out, and they know it's a numbers game. You two speak to this better than anyone out there in terms of knowing that it's a it's a job where and I'm simplifying this a lot, but you send out 100 emails a day and you get back, 10 replies, and of those 10 replies, you get one potential loan. And the next day you send out another 100 emails and you get back 10 and one might be a potential loan. And so it's important to keep going because you're always looking ahead to the referrals that you receive now and the work that you do now may not pay off until January or February, if or maybe even later. So it's the loan officers, the loan originators I talk to. Yeah, there's a lot of things going on up in the stratosphere, but they're still sitting there sending out their 100 emails a day, for lack of a better term. And so they just keep going, and they just keep trying to help their borrowers. So
Yeah. For me,
speaking of you two knowing that better than anyone, I don't know how often Audrey or Kevin, you guys ask for maybe a large firm to come in and help, sponsor this show. But I would think that some company out there would enjoy the publicity, enjoy working with you too. And so anybody who's on this call, reach out to Kevin or Audrey about something like that. I think it would be a good thing. I know that you do this out of the goodness of your heart, and Audrey, you do it so you can beat up Kevin, and Kevin, you do this so you can beat up Audrey on a weekly basis. Uh, but it's a good show. So
yes, I do this to indulge my S&N proclivities. So let's talk for a moment about credit. So the average credit increase for 2026 is 45%. That includes Vantage, by the way, although we were promised that would be a huge
hang
savings.
on, the average what is what?
Average increase in credit costs is going to be about 45%. Since 2022, when a credit report could be gotten for, say, $50, we're now at somewhere between $150 and $200, which is about 400% since 2022. So just buckle up, kiddies. And I'm wondering if this will push more of us to collect credit fees up front when Kevin and I are teaching NMLS and we poll the classes to see who's doing it, who's not. It really depends. A number of people, a lot of people are doing it now. They're collecting the
Mhm.
credit cost up
It's a
front,
growing number,
and
but
they're
not everybody.
Yes, exactly. And but they say that they're not getting pushback really. So that's something, right?
Yeah, that isn't that the is wasn't that the standard response a year or two ago when when individuals and companies first brought up the subject of collecting credit
Yeah,
money up front? It was like, oh, I don't want to lose my borrower.
yep.
Really? You're gonna lose your
Yeah.
borrower over like asking for something up front? Really? Eh, I,
Well, I don't know. Right now, I'm losing borrowers just because I said, call me. I mean, is that I was talking to a bunch of other loan officers the other day, and we're like, yeah, have you noticing like these people are just disappearing? They want to buy a house, and you call them back, yeah, we can do that. Everything looks work. Let's set up an appointment when you come in, and then nothing. They drop off the face of the earth. It's like they never happened. And he goes, yeah, it's just happening time and time again, and it's really frustrating.
Don't you think a lot of that is seasonal as people are getting towards the holidays that
Could be,
they're like, okay, this can wait. So
yeah.
I mean, those are some of the conversations is this can wait. And so I don't know. I see it as not quite a trend at this point. So Rob, I wanted to talk for a minute about LO comp because I get very cranky every time I hear a bunch of people on salary discussing LO comp because those people sit in an office and they wait for us to send them a loan and then they manufacture that loan and fund it and then they're pissed that they have to pay us. And so I saw this was out of your column. If an independent mortgage banker IMB pays a point on a $500,000 loan in compensation, that's 5 grand. We just learned that the MBA survey on that total loan production expenses, commissions, comp, occupancy, equipment, and other production expenses and corporate allocations increased to 326 basis points in the third quarter of 2025, and per loan costs increased to $11,109 per loan in the third quarter. The best way to lower costs is increase your pull through, of course, but expenses matter. And I'm wondering why when it is talked about over and over again amongst other people about how important it is and what we're seeing with our clients, how important the LO touch is in almost every circumstances, with very few exceptions. Why do keep people keep highlighting the fact that we get paid? Because what they're not talking about is the tons of borrowers that we vet for them for free because we don't get paid on them. And we're the
Mm-hmm.
ones at risk of having the EPO exposure at the end if that borrower turns around and refinances through absolutely no fault of ours 4 months later. So help me understand that. How do we shift this conversation to something that is a little more fair?
well, so they talk about the LO comp. They being they
Hey. Yeah.
talk about LO comp is 100 or 150 basis points or whatever it is. They say, well, look at credit unions. Credit unions are on the upswing, and credit unions only pay like 10 basis points or something. They pay their LOs 4 grand and 10 basis points. And so some of these institutions out there have an automatic competitive cost advantage when their compensation structure is different. The no IMB, no independent mortgage banker, whether it's American Pacific or Cross Country or whoever, you know, Fairway Movement, you name it. Nobody wants to be, quote, the first penguin in the water to cut compensation and say, oh, we're going to cut, we're going to go from a point and a half down to a point or a point to a half a point, and we're going to take that money and we're going to put it into marketing and we're going to put it into training. And so you'll actually have more loans in your pipeline and so you'll be doing more, you'll be making less per loan, but you're going to do more loans. But nobody, you know, Ron at Cross Country and Steve at Fairway and yada yada, they don't want to do that. They don't want
Mm-hmm.
to rock the boat because they'll come back from lunch and half their LO staff will have gone somewhere else that still pays
Right.
whatever it is. Um, the it comes up because Audrey, when you talk about oh, credit goes from $100 to $150, or title insurance goes from whatever to whatever, or whatever, gee, I got to pay, $30 for a notary. Gee, last year it was only $20 for a notary. When you add up these things, yeah, commission is definitely the largest part of the cost of the loan. But nobody really is doing much about it, and nobody seems to want to do anything about it. So there we sit, kind of treading water. And we can say, well, credit costs, Bob Brooksmith comes out and says, this is a monopoly, this is an oligarchy, whatever Bob called it, and complain about it. Um, and it's easy to point to Fair Isaac and Experian and so forth and say, well, you guys are the bad guys. Uh, but on the flip side of that, when you look at the biggest part of it, yeah, it's loan officers who are out there. And yeah, you're right. You're talking about vetting deals and dealing with borrowers who don't call back and so forth and so on. It's a numbers game with you guys too. I mean, you're not making a bunch of money on every loan, every phone call that comes in, right? You only make it when actually the loan funds, as
Hmm.
does the company. And like I said in the commentary, the best way to improve your cost is to increase your pull through, you know, to do what you can. I think that's a huge, oftentimes forgotten component of all of this. And I think companies who have a lower cost to produce have a higher pull through. And along with that higher pull through, it's better for the loan officers as well.
I agree on the higher pull through. I think there's a real disconnect between people who get a salary every week or every 2 weeks and those of us who are on the ground fighting for the borrowers, paying our own expense, no ability to deduct our business expenses at all. It's every time I see or hear that conversation, just ugh. Okay, but because I am Mary Sunshine, I want to end on a positive note, shall we? So, according to Experian, renter sentiment is improving, people. That means 47% of those polled believe that they'd be ready to purchase in the next 4 years, with 67% thinking they can do it in the next 8 years. So, get out there, go find those people and get them ready. They might need help with their credit or putting together a down payment or figuring out how they're going to qualify. Go find them. Get out of your office and go meet them somewhere because sending out those 100 emails isn't that productive from my experience. So, Rob,
No, I was just using that as a
Oh, yeah, yeah.
example of do do the same thing every
yeah,
day,
yeah, yeah,
and
exactly.
it's a routine.
Yeah, exactly. So make sure your routine includes being face to face with actual humans in person. That's how you create relationships. And on that note, Rob,
Wait,
thank
wait. One last note. What is your favorite pie for Thanksgiving?
Pumpkin. I have some upstairs right now.
Audrey?
I don't know. I don't really
No pie. Okay.
know. I prefer raviolis on Thanksgiving, so I'm probably the wrong person to ask. So with that, have a very happy Thanksgiving, a very, very happy Thanksgiving. We're very grateful to everyone who listens to us every week and participates and shares their input. And we just feel really lucky. So thank you. And Rob, have a lovely Thanksgiving. Go,
You guys too.
don't stop working, people. Keep going. Happy Thanksgiving.